Welcome to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Sina Lundholt.
And today's episode is part of an ongoing series on the 4 principles of investing according to Warren Buffett and Charlie Munger. And if you haven't listened to our previous episodes on this series, feel free to go back because we start out with number 1, meaning, or also known as circle of competence. Second, management. And third, moat, or a company's competitive advantages. And today's topic is especially exciting to me, and it's called margin of safety, which is another way of saying that you want to buy something of high quality at a deep discount if you can to what you believe the value of that item is. And to explain a little bit of what that means, imagine you're going to a grocery store and as an example, I'm on the lookout for super fresh, high quality mozzarella, and maybe it's normally at retail price of $4 a pound, and now it's on sale at $2 a pound. So for me, that's a 50% discount to what I believe is the normal, going price for the mozzarella. And so if I can buy it at only $2, I'm going to stock up. And this is the same mindset you want to carry with you when you're buying a high quality business in the stock market. So you want to decide what is the value of the business and buy it at a discount, ideally at least 30 or 50% or more at a discount to what you think the real value of the company is. So you don't want to just settle for whatever price the stock market is offering you on any given day, because you can think of that as kind of the retail price. And so you want to get it at a discount to, the kind of common retail price that everybody else is normally paying, but you're going to get an even better deal because you're smarter than everybody else. So with that, we're going to continue on with Sina's checklist on this margin of safety concept.
Thank you so much, Michelle. So we are on to the final step of Warren Buffett's 4 methods using my checklist. And in the show notes, we'll send you a link over to how you can get that checklist. As Michelle talked about, we already went through the first principle that Warren Buffett has. One, you're capable of understanding the business and it's in sync with your personal values. The second principle is that the company must have management with integrity and talent. The third thing is that it must have a competitive advantage, be better than their competitors, because we're looking for winners. And then finally, step number 4, no matter how wonderful this business is, it's not worth an infinite price. So we want to buy it at a margin of safety, like Michelle just introduced. So buying a stock in a company, we've mentioned it before and we'll mention it again. You're buying a part of a company. You are a business owner once you own that stock. And if we had to buy the entire business, what would it cost? And that's what we're going to talk a little bit about today, because as an investor, you want to know what the company is worth. It's called the intrinsic value. And then we want to know what the company's value per share is. And once we found the value per share, that the stock price that we want to buy, the price we want to buy the stock for, we also want to buy it at a margin of safety, the discount that Michelle just talked about. And that's the whole essence of this Buffett-style investing discipline, to buy a stock at a lower price than what the company is worth. And we want to buy a quality business, which is why we did the first 3 steps. Warren Buffett, he actually says the 3 most important words in investing are margin of safety. And there are many, many different valuation methods out there. There's owner's earnings that Buffett is mentioning. We'll get back to that a little bit later. We have discounted cash flow that a lot of business professionals from the business schools out there are using. There are price earning methods, and it all sounds very fancy, but it's also very, very important to do. And in this show today, we're going to go through a very simplified valuation model because it's difficult to convey in a podcast. But I want to plug my investing workshop where I have a tool where you can put in all the data, it's easy to find, and then the tool will automatically calculate the value, the stock price for you. But as mentioned today, we will walk through a simple valuation model. It's made by Warren Buffett's mentor, Benjamin Graham, and it's an easy and quick way to answer the questions that you want to answer when you're looking at a margin of safety. So the questions are, number one, what is the value of the business? And number two, can the business be purchased at a significant discount from its value? So when you look at a stock in the stock market, you want to buy it at that significant discount. A stock price is not just a stock price, there's actually a company behind that price. So yeah, Benjamin Graham, in my checklist that you can download, I have a question, like it's 2 steps that you have to go through to make this valuation. The first question is, I have studied the company's price earnings ratio, the PE ratio, over the past 5 years. The highest PE ratio during the past 5 years was, and then you have to write that down. So let me break it down for you, what that actually means. The price earnings ratio, also called PE ratio, this ratio shows the ratio of the stock price compared to the earnings of the business. It's again one of those fancy terms, but it's actually easy to find the PE ratio. For example, if you open Apple's stock app, it's right there in the overview of the stock. You can actually see its PE ratio.
Yeah, and you can also see it, like if you Google a stock in the, Google, you can find out the PE right away with a little stock chart, or in Yahoo Finance. Like the PE ratio is pretty standard. It's kind of everywhere. So yeah, it's easy to find.
Exactly. And this calculation that we're doing today is a valuation where you will have to follow the PE ratio. You won't get the stock price that you have to buy the stock for. You simply have to follow the PE ratio and make sure to monitor that in the app or online. It won't give you the stock price. So you find a chart with the company's PE ratio over the past 5 years. And in this example, let's use Apple. So you find a chart, for example, on macrotrends.net, where you can see the PE over time, how the PE over time progresses. And that's the first thing. And you go back 5 years, and then you see on that chart, when was the PE the highest? And in the example with Apple, the highest PE in 5 years was back in 2020, when the PE reached 35.4. And that's the highest PE ratio. So that's what you have to write under question 1, is the 5-year high PE is, and then you write 35.4. Then you move on to step number 2, which is in the checklist. I can buy this stock at a margin of safety when the PE ratio is less than 40% of the highest PE ratio the stock had in 5 years. So what you do is you take 40% of 35.4. Remember that if you say 35.4 times 40%, you then have to minus with 35 to get the right number. The right number is 21.24, and that is a PE ratio. So that's what you write in the second field. And if we look back at the Apple PE ratio over time, we can see that it hasn't quite gone down to 21.24. In the spring of 21, it was really, really close. Maybe some days in the spring of 21, it might actually have reached. We can't see it in that detail on the macrotrends.net chart, but we can see that today it's not down there. So we would have to continue to track the PE over time to actually make sure that we buy the stock when it reaches 21.24.
Right. So to make sure that I understand this, we're basically just saying we're getting Apple at ideally a 40% discount to what the highest PE had been. So when it was at the high of 35, we subtract 40% of that, and that will equal the 21 PE. So that's a rough idea to think about. We're getting Apple at a pretty good price if we can buy it at around that PE ratio of 21. So whatever the corresponding stock price is when it reaches that PE ratio, that's a pretty decent place to be. And again, none of this is advice. This is just an example of how you might think about this valuation criteria in applying a margin of safety.
Yeah, absolutely. And this is not necessarily the best valuation methods out there. There are many other methods out there. As I mentioned, I have a course where I teach step by step how to do it, and there's a tool. And Warren Buffett has spoken about, for example, owner's earnings in the past.
Right. And with owner earnings, back in some of Berkshire Hathaway's annual letters that Warren Buffett wrote, he would talk through a few ways that he values businesses, some of which he sometimes used book value. And he also thought about this other term called owner earnings. And he talked about this at length in his Berkshire Hathaway 1986 letter. So you can feel free to reference that if you want to know the exact details of what Warren Buffett wrote about. But basically, he arrived at another valuation method by taking a company's reported earnings and adding back in some of the items on the financial statements. And when you work out some of those items and, divide some of the outstanding shares out of that number, you arrive at, say, a valuation to, get at another figure for margin of safety. So I don't want to sound confusing for our listeners because it is a little bit more involved. If you want to read through specifically those paragraphs, it goes through the owner earnings description in way more detail. And Buffett provides some actual calculated examples of owner earnings. So you can check that out. Another resource people can check out is Phil Town's Rule 1 investing formula of owner earnings. And that's also talked about in the Invested book and also on, Phil Town resources online that you can probably find. So if folks want to go more into the owner earnings margin of safety calculation, you can also do it that way too. So basically, it helps you arrive at a discounted price to pay for a business. So let's pretend that the full retail price of a business is $100 per share. And if you can get a margin of safety price that tells you you want to buy it when it's at $50 per share, that's kind of what you're aiming for after you've done all the math and calculated things out. That's kind of what it's trying to help you arrive at, is that sort of valuation. And another sort of little shortcut I like to use of thinking about evaluating the market as a overall macro level, like this is not exactly what you should base your final investing decisions on, but to me it's a shorthand for giving me a clue if the market is starting to be on sale or if it's still not yet quite getting in the ballpark. And what this is known as is the Buffett indicator, or also known as the Buffett yardstick. And what it is the overall stock market known as the Wilshire 5000, and you divide that over America's gross domestic product, or GDP. And historically, Warren Buffett had said that the stock market was fully priced when this ratio was at 100% to 120%. And the American stock market had gotten so overvalued, especially during the pandemic years, that it reached as high as about 250% of stock market to GDP, which is like even double what Warren Buffett considers fully priced. So to me, I thought that the American stock market was by and large in a big bubble. So let's say we had a stock market bubble of 2020 going into 2021, and then that bubble started heavily deflating throughout 2022, and we could still be on the downtrend. So if you refer to one example of the Buffett indicator on a website like currentmarketvaluation.com, you can see that, as an example, as of the time we're recording this, the ratio was at about 164% market value to GDP, which is still around the one standard deviation above the historical trend line of the market. So we're still at least 64% above the fair value of the market. So we're still a little bit overpriced, and we can see that actually playing out in the S&P 500, where ideally you want to get the stock market, say, when it's only at 80% of the overall market value, and we're still at double 80%. And
Yeah.
Uh,
And
and
I think a lot of people actually might be quite surprised to hear that, because at least a lot of the social media stock memes, etc., are talking about how the prices of the stock market right now, how everything is on sale. But according to the Buffett indicator,
right, a lot of beginner investors might make the mistake, and I made the mistake of thinking once upon a time, like, oh, the market price of this stock is going down. I must have made a mistake. Maybe I should sell it because, it's scary seeing the stock price go down. And then, I probably sold some stocks when I was younger because I was afraid. And the only reason why that happened is because I didn't truly understand what I was owning, and I didn't know what the business was really worth. So the only criteria I had to go by was the stock price, which is not necessarily a good reflection of the actual value of the company. So this is something that, many of us go through. We all
mhm.
have sort of been there in that, way of thinking that, you start getting worried when the stock price is going down and you think you made a mistake and now you lost money when you had to sell it at a loss. So, I just want to say, like, this way of valuing companies helps you to not get into that trap and not fall into that way of thinking, because now you get to have conviction about, what the real value of this company should be based on, the company generating plenty of profits and earnings and free cash flows. So you're like, you believe that the company will still win even if temporarily the stock price goes down in the short term, but over the long term, eventually people will realize the true value of the company and it will go back up to higher stock prices. So yeah, I just wanted to add that part, but back to your checklist.
No, yeah, it was a super good point, and I can definitely also identify with what you just said there about my own journey before I learned about Buffett style of investing. So thank you for sharing that. One thing that I want to add before I move on is that this valuation strategy, it only works for stocks that is quality companies that follows these 3 steps of meaning, management, and moat that we're talking about here, Buffett's principles. It does not work for stocks that you heard about in the news or in a group on Reddit or at the water cooler at work. You have to do your homework first before you do the valuation. You can't just, well, you, of course, you can start doing some valuation on a company, but if you don't know if it's got management with integrity and if it does have a durable competitive advantage, you're not necessarily buying quality. So it's so important for me to just, remind you all of before you start doing any calculations that it's actually on quality companies. It only works for the Buffett style quality companies. So make sure that that you do that before you start doing these calculations. There's a lot of people that jump right onto this step once they've heard about Warren Buffett. But remember, he also talks about management and moat. So the third part of the list, the last question under in the section of margin of safety is the question here. What was a situation in the past where the company's stock was selling at a very low price? Multiple events can be described. So in this section here, you want to go back and see what was an event in the past where the stock price of this quality company fell. And you can learn from that experience. Was it a general market crash, for example, or did the company go through an event? An event would be that something is happening to that business that makes the stock crash. For example, Chipotle at some point had some problems with E. coli bacteria in some of their food. It actually happened on multiple occasions, so the stock simply crashed. The company was trading at a very low price compared to the intrinsic value, and value investors at that time were able to actually scoop up this company at a very, very great price. So make sure that you understand what happened, but it could also be something general that happens to that industry or sector from time to time. I know that Micron is going through times where the stock price isn't that great because there's not new innovation, but then 4 years later they come out with something new and boom, the price goes up. Do you have anything about events, Michelle, something you want to add in terms of events?
Yeah, like for example, during March 2020, when the pandemic was first, happening around the world, that may have been a possible opportunity to buy some great businesses on sale. And some business stock prices have never gone back to some of those levels that they went down a good amount during that March, I want to say flash crash. But at the time, I made the mistake of thinking like, okay, if this is going to be the big one, I don't want to get too much in the market yet because like to me the S&P 500 was only down like 35%, like I say only, but I was thinking like, oh, I want it to go to 50% off on sale. So I was waiting a little bit as a proxy for some other companies I was interested in buying, but they still hadn't come down enough in my opinion of getting to my margin of safety price. So I
Mm,
had waited to buy some companies. Some companies I did, but like other ones, some of my other holdings were actually down like 60%. And I was like, well, I guess I have to wait until this recovers. So at least, even though I did not get to maybe buy some companies, maybe I should have in retrospect, at the same time, I didn't just freak out and sell one of my other holdings that was down 60%. I was like, I'm going to write it out. And even though it's awkward and it's nobody likes looking at their portfolio bleeding red, it's just like not fun, but in spite of maybe to some people that example company I was saying that's down 60%, that could have been an amazing time to buy that company if you knew what its intrinsic value was and it's going to go back to you know the higher price someday. So sometimes
yeah, my
you have to take the opportunities you can get.
absolutely. My big regret from from 2020, March 2020, was I did not get to buy enough before the price went up again. So yeah, I was like, I wanted to buy more portions or tranches, as we called it, and
Mhm.
I just did not get to do it because stocks just went up really fast after that. So the essence of that is that sometimes the stock market as a whole crash and stocks go down like an elevator, but that doesn't mean that every single business in the stock market from one day to the other is worth less. The company's intrinsic value might be the same as the day before and not
Mhm.
at all impacted by this crash. And that's why you can get it at a sale when that happens.
Right.
But you really need to know your company because the crash could also impact the company. Like, for example, right now, if the stock market crashed because of inflation, for example, then we would need to really understand the business, that the business wouldn't be impacted by inflation and that they could still increase prices or whatever they would need to do to actually overcome the event that happened. So, yeah.
Right. Exactly right.
All right. Well, that was what I had for today from this checklist. I don't know if you have anything to add before we end the show for today.
Well, all I wanted to also note was, we hope that what we tried to explain in margin of safety made sense. And if you have questions for us, you can email us at investingmastermindpodcast@gmail.com. And also, it would be a huge help to us if you wouldn't mind reviewing us on wherever you listen to your podcasts, like on Apple Podcasts or Spotify and so on. It would be a great help. And we greatly appreciate everybody listening, and we really hope that this will help you along your investing journey as well.
Yeah. And I also wanted to add that I'll put a link to my workshop in the show notes so you can easily find it. But that's it for today. I hope you enjoyed the show and we're back on Tuesday. Take care until then.
Bye bye.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice. And if you need help in your personal situation, please consult with a professional.